All right, welcome everybody. Today's session, we're going to look back today at trends in the payment industry in 2022. We'll discuss the outlook for 23, and perhaps most importantly, we're going to talk about steps that subscription businesses can take themselves to set themselves up for a more successful year next year. So before we get started, I want to go through a couple of housekeeping items. Down below you on the desktop, there are some links to some very important documents. I suggest that you download those. A lot of the things we're going to talk about today will give you more insights and more concrete steps to take in those documents. We will be supporting live questions. There's a Q&A box on the desktop, so please feel free to ask any questions to Darryl and myself in those. And if we cannot get to all your questions today live, we will, of course, respond directly to you after the session is ended with any answers to make sure that you have whatever we know about the question you asked. So let's get started. I want to introduce myself. My name is Steve Arentzoff. I am the Senior Vice President of Marketing for FlexPay. We have a very special treat today. I'm joined by Darryl Hicks. Darryl is a founder and CEO of FlexPay, and perhaps most importantly, Darryl is one of the most foremost experts on the payment system and some of its problems and how do you make the system work for you. Every time I speak with Darryl, I learn something new, and I'm sure that you will hear today as well. So we're going to go through a very wide-ranging conversation about the impact the slowing economy has had on the payment system, and of course, by default, what impact this had on merchants in 2022. We're going to look into trends going into next year, and again, we're going to talk about what subscription businesses can do, concrete steps to take to make sure they're set up for the next year for the most success. So welcome, Darryl. Thank you for joining us.
Great to be here. Excited to connect in with you, and thanks for the kind words, Steve.
Yeah, of course. So let's start today's conversation and step back and take a macro look at the economy. I'd love to hear your thoughts about what impact you're seeing on the payments system, what you're hearing from customers, and are there data that are going through the FlexPay platform that gives you an insight into some of the stresses that have been caused by the slowing economy?
Yeah, for sure. We are uniquely positioned with our platform and the volume of transactions that runs through it to kind of get early indicators on where there may be some stress showing up in the economy. It's kind of interesting what we've been seeing on our platform. We've seen in the last 6 months or so a marked degradation in performance on approval rates for several of our merchants, but not all of them. Some of them seem to be performing pretty much the same as they were several months ago, whereas others, it feels like it's kind of almost split off into a Y, where there's people that are on this really great trajectory, and then others who seem to be really struggling quite a bit. Some of that does map into demographics that our clients are selling to and servicing. Some of it also is affected by price point. But one thing that we're seeing across the board with all of our merchants is they are complaining to us when we do our QBRs of lower performance on their marketing initiatives and sales initiatives. So it seems like it's getting harder and more expensive to acquire new customers. There's been a pretty sharp fall off in that. But definitely what concerns us the most is seeing how the customers that we already have, the ones that have said, yes, I want the goods or services that you're selling. I want to enter into this special relationship with you for a recurring billing subscription. And the passive churn, the involuntary churn that's coming from failed payments, seems to be worsening at a precipitous rate for quite a few merchants.
That's great. I'd like to come back to the churn conversation, because I know it's a really important part of the overall subscription business model. But I'd like to dig into one of the comments you made first. You talked about the fact that there are different effects being felt by different merchants from the payment system, from failed payments and chargebacks. It feels like if different merchants are experiencing pain in different ways, that the payment system is affecting different merchants. And it's not operating the same way for every company. It's not operating the way probably most companies think it should operate, which is card payments come in, they're either good or bad, legitimate customers are not legitimate, and declined or approved. So it sounds like this is far from the truth if the system operates this way. Is that true?
Yeah, definitely. This was kind of one of the epiphanies that we ran into when we were, responsible for processing a significant amount of transactions, in our previous business where we had developed the FlexPay technology. We either sold to directly or serviced tens of millions of customers across 4 continents and had an almost maniacal focus on, how to increase lifetime value, become more efficient and optimized. It turned into a really significant competitive advantage for us in the marketplace. And we detected early on that your failed payments kind of fall into 3 buckets. You have transactions that are insufficient funds, say. And then you have these other ones over on the other side that are, maybe the card is closed, or maybe you get an error code that says, lost or stolen card, pickup card, destroy card, cards expire eventually. But then there's this big sort of squishy part in the middle that kind of gets captured in the do not honor or generic bank decline reason codes. And those ones would seem to vary by merchant and it would kind of move over time. And what we discovered is that there are systems inside of the modern payment stack that we have that are trying to determine where there is risk and where there isn't. And they're really trying to protect the issuer and the issuer's bottom line. Of course, the card issuing banks will tell you they're also trying to protect their cardholders. But ultimately, what they're really trying to do is reduce their exposure to potential fraud losses. And so there's this really squishy middle part of what the banks actually call false declines. And for some merchants, it can be as much as 80%, maybe even 83% of their failed payments are false declines. But even the highest quality merchants that have the least amount of problems still have a small amount of these false declines, this needless churn inside of their business caused by improperly tuned systems on the issuing side that are throwing out legitimate transactions that just look a little bit sketchy or suspicious.
So I would imagine that if a card payment fails in a subscription relationship, whether it's the first month of billing or the 10th month of billing, that if it's not resolved, that's going to create churn. Is that the involuntary churn that you were referring to?
Yeah, absolutely. And this is mission critical for a subscription business to understand and to get right, because, let me be a bit provocative here for a minute. I think there's really only 3 things that can give you an unassailable lead in your marketplace. How well you sell, which is all about how you outthink the marketplace. How well you perform or deliver on your promise, your brand promise, which is all about whether people stick with you, whether they'll refer people to you, and how well you collect the money. Everything else is noise. How well you sell, how well you deliver the value, and how well you collect the money. And business is fundamentally a relationship between delivering value and collecting money. How well you sell is giving you the license to do it with a customer. You get those 3 things right, and you get an unassailable lead in the marketplace. We just happen to be obsessed with how you collect the money part of that equation. And I think that sadly, it's quite often the most overlooked, because the mistake that's easy to make is that you assume that when you're running a subscription business, all you need to do is just select a vendor for a merchant processing, negotiate hard with them on price, and connect your system into their API and process the transactions, and everything just works as it should, kind of what you were alluding to earlier. Once you understand that that's not the case, that there's actually a structural problem inside of the payments ecosystem that is directly contributing to churn in your subscription business, then you start to understand that it's something that you need to manage, right? This is why we see the emergence of this new category, payments authorization management. As the name denotes, there's something that needs to be managed inside of payment auth, right? It's true. There is this structural problem, and we're super passionate and on this mission to try to pull back the curtain and open the kimono and let people see what's actually going on in here so that they can manage it properly. I mean, we see with quite a few of our customers, the average across our customer base is about 48% of all of their churn is coming from failed payments, which is massive when you think about it. It's the single greatest driver of churn. And especially as we're entering into an environment where it's harder and more expensive to acquire new customers. This is why it can give you an unassailable lead, a massive competitive advantage. If you get this part right and you don't have that churn, or at least if you don't have as much of it in your business, it significantly reduces your selling costs. You end up with much higher lifetime value. So your marketing spend as a percentage of revenue becomes much smaller, which allows you to tap into markets that previously weren't as profitable. It gives you significantly better margins and unit economics. I mean, we've seen this firsthand. It can really become a transformational thing for the business. So understanding that there is this problem here, that there is something that needs to be managed, I think is the first step. And then the second is to say, well, how much is this affecting me? Which I know we're probably going to talk about that a little bit later, but I see world-class merchants are really, really good at doing this. They are really on top of their numbers, and they really understand at a deep level what portion of their churn is coming from failed payments. What's the true lifetime value impact on that? Because again, remember, we're not when we're in a subscription and we have a failed transaction, it's not just a failed transaction, it's a failed relationship. We're now losing that customer and all the potential revenue downstream. For many of our clients, that can be as much as like 12, 13, 14 more months or several more years of recurring transactions that are being needlessly interrupted at this point. And once you understand that, then you can start to really build the desire and the momentum that you need cross-department within your organization to bring in finance, operations, and IT to say, okay, well, what are we going to do about this now that we understand the scope of it?
That's awesome. Now, one thing I want to recap, as you said, was based on its connection to the core performance metrics that we know subscription businesses manage themselves by. So we know that two of the key metrics are customer acquisition, how many new customers are we bringing into the business, and then retention, how long are we keeping those customers? So what you said, we know that it's becoming more expensive to acquire customers. It's becoming more challenging. Fewer customers are being acquired. And yet, if there are more and more payment issues on top of voluntary churn or customers ending subscriptions in order to manage their household budgets, that it's a double squeeze that's being created for subscription businesses. So what are a few solid steps that merchants can do to help increase the LTV? Because it feels like if you can solve this problem, if you can focus on voluntary churn, it's one of the few levers that companies have in the short term that's within their control to be able to improve their profitability.
Yeah. Well, the good news is there is something that can be done to manage this and to improve it, right? As I alluded to earlier or laid out earlier, I think the most important thing to start with is to actually measure it, right? I'm a big fan of that old Peter Drucker quote. Peter Drucker 101 says that what gets measured gets managed, or what gets measured gets done, right? So once we are measuring what impact, even just asking that simple question, okay, we have a churn problem. Our lifetime value would be higher if we didn't have as much churn. What portion of our churn is voluntary versus involuntary? Active versus passive? Just asking that one question alone, like it's so shocking to me to see how few subscription merchants even report on that internally, tracking their churn in those two separate buckets. And then once you see how much of it is coming from the passive churn, again, starting to extrapolate out what's the future lifetime value of customer that was just lost as a result of this needless interruption in the relationship with the customer. So I really think that's step one. And then step two is to really start looking into what are the options that I can bring into my tech stack for payments authorization management. There's a few low-hanging things that I recommend to merchants all the time. Something as simple as look at the time of day where you're batching your transactions, your subscription transactions, regardless of whether they're annual renewals or weekly renewals or monthly renewals. All things being equal, if you can batch those to be processed during business hours, ideally in the afternoon, East Coast time, you're going to see a significantly higher approval rate than if you're running those transactions in the middle of the night, which is something that IT departments tend to do because they think, well, we're just going to batch all these transactions when server load is low and the internet's more quiet and we can get things processed, without realizing that they are inadvertently making the problem of failed payments worse. And the reason why this happens is because even today in 2022, the fraud systems inside of many of the issuers look at the time of day of a transaction, and that's one of the inputs that goes into their risk matrix. Turns out that they think that if a transaction is card not present and it's running in the middle of the night, it's a higher risk of it being some sort of fraudulent activity. So there's all kinds of little things like that that start to come into the equation. So we talk about the time of day. We think about the quality of your merchant category code. making sure that you're working with a high quality merchant processor who really understands MCC, your merchant category code, and gets you into the proper MCC, not just for optimizing your rates that you pay on your merchant processing. Way more important than that is the impact that it has on your approval rates. And there's a massive variation in approval rates by MCC just for the same business. I mean, I had one of our clients was a SaaS business that was selling a software solution to credit repair companies and to other agencies that were reaching out and collecting debt. And the merchant processor that they were working with, I won't name names, but it's a really large, well-known household name, typical merchant processor that a technology company would go to when they're starting up. The account rep who was opening the merchant account put them into an MCC that had to do with credit repair. What do you think that their authorization rates looked like when they were processing transactions? We switched them over to the MCC, or to ask them to go to their bank and switch over to the MCC that's used for software as a service, SaaS, computer software businesses, and they saw their approval rate went from an average of 83% approved on fresh transactions to over 90% approved on fresh transactions. Nothing else changed in the business. None of the marketing, none of the demographic, none of the price points, just changing their MCC. It had that much. So you can say, oh, my bank told me I should be in this other MCC because I'm going to save, 30 basis points or 3 basis points on some of my transactions. What's that compared to the impact that it could have on your approval rates? So again, as you can tell, I'm a little bit passionate about this, and I'm going to keep going down rabbit holes if you let me, Steve. But all that to say, do the work to quantify how much this is impacting your business. Communicate that internally in order to rally everyone around this to create the desire, and then start looking at payment authorization management as a category and the tools within it, and start to inform yourself on what you can bring into your tech stack to move this. And that will give you a massive competitive advantage, especially in this new phase of the economy that we're going into, and ultimately can lead, like I said, to an unassailable lead in the marketplace.
That's fantastic. I think one of the themes that we really want to communicate in today's session were concrete steps that businesses can take, way to look at themselves to start to solve this problem and drive better performance. And what you're really bringing out is that this is a very complex problem and companies really have to put effort behind it. But the value of focusing on a solution is profound and what it can mean for more revenue, longer retention, higher LTV for customers, and ultimately more higher levels of profitability. One thing I want to dig into is that companies typically look at problems as involving people, processes, and technology. And if I use that approach, measuring data, addressing technology solutions like payment authorization management solutions, what can you talk about on people and org structures and how companies should assign responsibility for understanding these metrics and having ownership of solving them?
Yeah, I think, in our experience, typically it's rolling up to someone in finance, right? You will see in some organizations, there's like a VP of product, someone who's responsible for the P&L of a given product line, who's really looking for opportunities to optimize the P&L and generate the highest possible revenues, and really focused on chargeback rates and refund rates and decline rates. But generally speaking, there's someone usually on the finance team, especially in a larger organization, who's responsible for payments and all the payment vendors that they work with, right? Understand, and that makes sense, right? Because there's a huge financial impact on the business when this happens. But if we're going to really get the right solution rolled out, where we've seen the companies that are really doing this at the best, call it the gold standard, is again, like I was alluding to earlier, where they're bringing in operations and they're also bringing in IT, and they're having a conversation together across department to say, look, this is the true scope and scale of the pain that we're in, and we need to work together to find a way to get this solution and get the buy-in across departments. Because even there's a few things that we can do that are kind of low-hanging fruit that will help to boost performance and solve this pain point about how well we collect the money from our customers, and reducing the needless friction that's inside of there. But some of the best solutions that are really going to give the highest return are going to involve some tech rollout, right? So what platform are we on? What options are available based on the platform that we're in? And helping IT to really understand why this is so important, the true depth of the impact that it's having, in order to create that buy-in even in other departments. So I think again, that's where we've seen this go really, really well, is where there's usually someone in finance who's championing it, going and collecting the data and then presenting it out to the broader departments in order to really make sure that everyone's taking it seriously and pushing hard on the initiatives that are required.
That's great. Thank you. I think just to recap then, create responsibility and accountability around the numbers, provide the necessary information and data to be able to track the problem, to be able to create the relationship between the problem and the harm it causes, and ultimately the benefits of solving the problem. And just want to comment, one of the other best practices we're seeing some companies actually lean into is the creation of a chief subscription officer and starting to create more organizational alignment around a single P&L that owns the relationship from start to finish. So different ways to skin up, but I think the technology component is going to be a key part as well, because again, it's such a complex problem. So let's also shift gears and talk about 2023 and what the forecast we're seeing for the economic environment, and whether or not you see some of the challenges that companies have dealt with this year still being in place, or perhaps even becoming worse next year.
Yeah, it's interesting. Everyone's kind of wondering, are we going to head into a recession? And I can tell you, I really believe that recessions can sometimes almost become a self-fulfilling prophecy. The more people are worried about a recession, the more likely it is to happen. And what's of concern to me is that, again, just, from my own internal view, the behind the scenes conversations that we're having with large customers of ours, like multi-billion-dollar revenue, publicly traded businesses, is that they are reevaluating all of the projects and initiatives that they're taking on for 2023. In fact, we had one client the other day, they had a changing of the guard at the CIO level, and there were 88 projects that were slated for development rollout in 2023. The new CIO came in and said, we're putting them all on the chopping block, and the only ones that are going to get approved for next year are ones that are directly accretive to the bottom line of our organization. And out of that 88, only 18 survived. So right there, you see like a pretty significant impact on what happens to those 70 vendors now who were banking on those projects moving forward with a potential new client. So I think it's inevitable that we're going to see some sort of a pullback. There are people out there way smarter than me that I'm talking to who are saying that we should prepare for a hard landing and a pretty challenging 24 months to come. Like I said already, when we do our QBRs and as I talk to senior executives within some of our largest clients and fellow CEOs that I do a lot of masterminding with, we are seeing that there's been a significant increase in cost of acquiring a customer, which means we have to start to shift our focus on optimization and efficiency. It's time to batten down the hatches, whereas before there may have been this grow at all costs kind of model, go out and do the land grab. I think now we have to have a shift towards focusing on unit economics and profitability and sustainability. The businesses who do that and do it really, really well are the ones that are going to thrive, not just survive, but thrive through this. Any recession that we've had in the past, we've seen absolutely dominant companies come out that were born in a recession that are huge parts of the economy and of the fabric of our society today. So it's not necessarily that I'm scared of it. I just think that now is the time to be very, very careful. Like I said, focused more on optimization and efficiency, which I think is, even though it might seem like a little bit self-serving with what we do at FlexPay, I really do believe, I am very passionate that this is right message at the right time, especially now as we're heading into what is likely to be a much more challenging time economically. We have to focus on reducing and removing any friction that we have where we are needlessly creating a moment of truth and an opportunity for churn with customers.
Makes sense. Certainly, it's been my experience that those companies that go into recessions or even just downturns and focus on efficiency and create a more profitable enterprise set themselves up to survive during the tough times, but also really create an opportunity to really outpace the growth and profitability of their competitors exiting it because they have a more solid foundation that they built during that time. So the technology increases, the process improvements, the efficiency gains that they create have outward impact for years to come. Okay, so we've run a little bit longer than I expected, which is fantastic. Such great content today for you. We're only going to have time for one question, unfortunately, but please, if you have questions that we can't get to, we will promise to get back to you with a follow-up email. The question I do want to focus on for you, Darryl, though, is coming in, it says, you have talked about measuring the total impact of failed payments and its relationship to creating customer churn. Have you seen that reducing the rate of failed payments does have a measurable impact and also reducing overall churn rates? Is that something that's provable?
Yeah, absolutely. So again, just imagine that you are one of these typical merchants, like what we see on our platform, where 48% of all of your churn is coming from failed payments. Now imagine that by rolling out a great payment authorization management strategy, you can cut that in half. What have you just done to your churn rate? You've reduced it by 25%, pretty much, 24%. You get half of that 48 that's gone. What is the trickle down impact on that? It's pretty easy to build in a spreadsheet model, what happens. Whereas, a certain number of customers acquired just keeps you flat in revenue. Now, all of a sudden, that same number of customers acquired is generating growth in your business. There are exponential returns off of this. That's why I use strong language like an unassailable lead in the marketplace, because really what we are seeing firsthand is that the merchants who do get this right do end up with exponential returns that give them this outsized competitive advantage in the marketplace, and they just really pull away from all of their competitors. And like you had said earlier, a solid foundation upon which to build when we do come out of a recession.
Fantastic answer. And just as a reminder, what Darryl means when he says exponential impact is a reminder that when you save a customer from churn, they don't just deliver revenue this month, they continue to bill month after month after month. And the compounding benefits of that revenue has a probably bigger impact on overall company growth than almost any other initiative you can take. Okay, Darryl, any last thoughts before we break today?
No, I'm really excited for the opportunity to get this message out here, and really grateful for the people that are coming in and listening to it as well, because I really believe that, again, based on what we've already seen, the customers, the clients, the merchants who get out there and do this right will actually generate massive returns out of it. And, as a founder and as a CEO and as a serial entrepreneur, it's something I'm really passionate about, because I think about all the jobs that'll be saved, the trickle down benefits to the economy. I think about the mental health and the stress that can be relieved from this. There's a lot of things, like, even though I talk to our team about how, yes, we're focused on payments, it might not seem super exciting. It's just such a critical piece of what it takes in order to build a wonderful business. And I'm super proud to be serving the merchants that we are, who just have phenomenal products and services. And I want to see them grow, and I want to see them thrive. I want to see them build the business of their dreams and get what they deserve. And I think that this is a really critical piece of it. So anytime I have the chance to talk about it, I'm always happy to make the time for it. So thank you, Steve.
Fantastic. Thank you for your time and your insights. And it's certainly wonderful to be part of an organization that is able to have these kinds of incredibly positive benefits for companies and help them succeed. So thank you very much. I hope everybody enjoyed today's session. Again, if you have any questions, please feel free to enter, and we will get back to you shortly.